In this video, we are looking at two fintech companies that are quietly reshaping how millions of people interact with money. These are businesses that are building massive financial ecosystems, capturing younger customers early, and positioning themselves to benefit from a future where traditional banking continues to fade into the background. By the end of this video, you will understand why these two fintech platforms are growing so quickly, how their business models create powerful long-term advantages, and why even a small investment today could compound significantly over time. These are platforms that are building durable financial infrastructure for the next generation of banking. If someone had just $500 to begin investing in fintech today, these two companies are among the most interesting opportunities to consider. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The first fintech company worth paying attention to is Chime, ticker symbol CHYM. Chime represents one of the clearest examples of how digital banking is reshaping the financial landscape. At its core, Chime operates as a digital-first banking platform designed for everyday consumers who want simple, transparent financial services without the frustration of traditional banks. Instead of physical branches, Chime built its entire platform around a mobile experience. Customers can open accounts within minutes, receive their paychecks through direct deposit, manage spending, and access financial tools directly from their phones. But what really sets Chime apart is its focus on eliminating the types of fees that have historically frustrated millions of bank customers. Many traditional banks still charge overdraft fees, maintenance fees, and minimum balance requirements that disproportionately affect younger consumers and lower-income households. Chime built its brand around removing those barriers. The platform offers fee-free checking accounts, early access to direct deposits, and features designed to help customers manage money more effectively. This simple value proposition has resonated with millions of users. Chime has rapidly become one of the largest digital banking platforms in the United States, with millions of active customers relying on the platform for everyday financial transactions. And this customer growth has created a powerful foundation for long-term expansion. The real opportunity for Chime is not just offering basic banking services. The opportunity lies in building a financial ecosystem around those customers. Once a user begins receiving their paycheck through Chime and using the platform for daily spending, the company gains the ability to introduce additional services, savings products, credit tools, financial management features, and eventually more sophisticated lending services. Every new product deepens the relationship with the customer, and deeper relationships typically translate into stronger revenue growth. One of the most important aspects of Chime's business model is how efficiently it operates compared to traditional banks. Because Chime does not operate a network of physical branches, its cost structure is significantly lower. That allows the company to scale rapidly as new customers join the platform. Traditional banks must invest heavily in real estate, branch employees, and infrastructure to support expansion. Chime does not face those same limitations. The entire platform can grow digitally, and that means customer acquisition can happen much faster. Another important advantage is Chime's focus on financial accessibility. Millions of Americans remain underserved by traditional banking institutions. Some customers struggle with minimum balance requirements. Others have limited credit histories that make accessing traditional financial services difficult. Chime built its platform specifically for these consumers. By lowering barriers and simplifying financial tools, the company has been able to reach customers that many traditional banks overlooked. This strategy creates an enormous addressable market. There are tens of millions of potential users who want simple digital banking services without hidden fees. As Chime continues expanding its product offerings, those customers become long-term revenue opportunities, and that is where the real growth story begins to take shape. Revenue for fintech platforms like Chime often grows as engagement deepens. The more frequently customers use the platform, the more transaction activity flows through the system. This transaction volume can generate interchange revenue from debit card usage and other financial services. Over time, additional financial products can create even more revenue streams. What investors should understand is that fintech platforms tend to follow a similar growth pattern. First, they acquire users, then they increase engagement. Finally, they expand monetization through additional services. Chime is currently in a phase where it continues expanding its user base while steadily introducing more financial tools for its customers. This combination can create powerful compounding growth over time. Another important factor is demographics. Younger consumers are far more comfortable managing their finances through digital platforms. Many of them have never developed strong relationships with traditional banks. Instead, they prefer mobile-first financial tools that are fast, transparent, and easy to use. Chime has positioned itself directly in front of that generational shift. As these younger users grow older and their incomes increase, the financial platforms they already trust can capture a larger share of their financial activity. That creates a long runway for long-term growth. Chime also benefits from strong brand recognition among younger consumers who view traditional banks as outdated and expensive. The company's focus on simplicity and transparency has helped build trust with its user base. And trust is one of the most valuable assets any financial platform can have, because when customers trust a financial platform, they are far more willing to adopt additional services, savings tools, credit products, budgeting features, financial planning. Every additional service strengthens the ecosystem, and ecosystems tend to become more valuable as they expand. From an investment perspective, this kind of scalable platform can create substantial long-term upside. Fintech adoption is still in relatively early stages compared to traditional banking. As digital financial tools become the dominant way people manage money, platforms like Chime could capture a growing share of that market. And if the company continues expanding its ecosystem while maintaining strong customer growth, the long-term opportunity becomes even more compelling. But Chime is only one side of the fintech transformation. Another powerful shift is happening in consumer lending, and that leads us to the second company investors should pay close attention to. Before we move on, a quick message from today's sponsor. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let us move on to the next fintech company. The second company worth serious attention is Affirm, ticker symbol AFRM. Affirm operates in a very different segment of fintech than Chime, but the opportunity is just as significant. While Chime focuses on modernizing everyday banking, Affirm is transforming how consumers pay for purchases and access credit. For decades, the dominant form of consumer credit at checkout has been the credit card. Credit cards offered convenience, but they also introduced a complicated structure of interest rates, revolving balances, late fees, and penalties that many consumers struggled to manage. Affirm introduced a different model. Instead of revolving credit that can accumulate interest over time, Affirm provides installment-based payment options at the point of sale. Customers can choose to split purchases into predictable monthly payments. In many cases, those payments are transparent and fixed, allowing customers to understand exactly how much they will pay and when. This approach has resonated strongly with younger consumers who prefer clarity and control over their finances. The model is commonly known as buy now, pay later, and it has rapidly expanded across online commerce. But what separates Affirm from many other companies in this space is its focus on building deep partnerships with merchants. Affirm integrates directly into merchant checkout systems, allowing customers to see payment options while they are making purchasing decisions. This creates a powerful advantage. When financing is offered directly within the checkout experience, it can increase conversion rates for merchants. Customers who might hesitate to make a large purchase up front suddenly have the ability to spread payments across several months. That flexibility often encourages higher spending. For merchants, this can translate into larger order sizes and more completed transactions. For Affirm, it creates a steady stream of loan originations and transaction volume. This model aligns incentives between the platform and the merchants using it. Merchants benefit from increased sales. Consumers benefit from flexible payment options, and Affirm generates revenue from merchant fees and interest on certain loans. But the opportunity extends far beyond simple installment payments. Affirm is positioning itself as a long-term financial platform that helps consumers responsibly manage credit. One of the company's core principles is transparency. Many traditional credit products obscure the true cost of borrowing through complex interest structures and revolving balances. Affirm instead focuses on fixed payment schedules that customers can clearly understand. This approach has helped build trust with users who prefer predictable financial commitments. Another important aspect of Affirm's strategy is its use of technology and data. The company uses advanced data analysis and underwriting models to evaluate credit risk in real time. This allows Affirm to approve transactions quickly while still managing loan performance. Because the platform processes millions of transactions across different merchants and categories, it gathers valuable behavioral data that improves its underwriting accuracy over time. This data advantage becomes increasingly powerful as the platform scales. More transactions generate more insights improve risk models, and better risk models allow the platform to expand lending while maintaining responsible credit standards. This feedback loop can strengthen the company's competitive position. Another major growth driver for Affirm is the continued expansion of e-commerce. Online retail has steadily grown as a share of global commerce, and many digital checkout systems now integrate financing options directly within the purchasing experience. Affirm has partnered with a wide range of merchants across different categories, from travel bookings to electronics and consumer goods. These partnerships expand the reach of the platform while introducing new customers to installment-based payments. As e-commerce continues growing, embedded financing options are becoming a normal part of the checkout process. Consumers increasingly expect to see flexible payment options when making larger purchases online. Affirm sits directly at the center of that trend. The company's transaction volume has expanded significantly as more merchants adopt the platform and more customers choose installment payments. Another interesting aspect of Affirm's strategy is its ability to capture repeat users. Once consumers successfully complete a purchase through Affirm and experience the convenience of predictable payments, many of them return to use the platform again. Repeat usage strengthens customer relationships and increases lifetime value. And as those relationships grow, Affirm gains more opportunities to introduce additional financial services. This is where the long-term vision becomes especially interesting. Affirm is not just trying to be a point-of-sale lender, it is gradually building a broader financial ecosystem. The company has already introduced a consumer-focused financial app that allows users to manage payments and access financial tools in one place. As the ecosystem expands, Affirm could potentially introduce savings products, financial management tools, or other credit services that deepen engagement. This mirrors a broader trend across fintech. Many platforms begin with a single core product, but as their customer base grows, they expand into multiple financial services that increase revenue per user. For Affirm, the initial hook is installment financing. From there, the ecosystem can evolve. Now let us talk about the financial context. Affirm has experienced rapid growth in gross merchandise volume as more merchants adopt the platform and more customers choose buy now, pay later financing. This growth reflects both increasing merchant adoption and rising consumer awareness. The company's network of merchant partnerships has expanded significantly, allowing Affirm to appear in checkout flows across many different retail categories. As transaction volume increases, the company's revenue opportunities expand alongside it. Another factor investors should consider is the size of the overall market. Global consumer spending represents trillions of dollars each year. Even capturing a small percentage of that spending through financing solutions can generate enormous revenue opportunities. Buy now, pay later has already become one of the fastest growing segments within consumer finance. And the companies that establish strong merchant relationships early could maintain those advantages as the market matures. Affirm has invested heavily in building those merchant relationships. Many large retailers integrate Affirm directly into their checkout systems, allowing the platform to appear at critical decision points during purchases. This placement is incredibly valuable. Consumers often decide how they will pay for a purchase at the exact moment they reach the checkout screen. If Affirm appears as an option at that moment, it becomes a natural choice for customers seeking flexibility. That positioning can drive significant transaction volume. Another advantage is Affirm's focus on responsible lending practices. The company evaluates each transaction individually rather than offering unlimited revolving credit lines. This approach helps limit excessive debt accumulation while maintaining predictable repayment structures. As regulators and policymakers increasingly scrutinize consumer lending practices, companies that emphasize transparency and responsible credit structures may be better positioned for long-term growth. Affirm's model aligns well with that environment. The company has also continued improving its financial performance as it scales. Like many fintech platforms, early growth required significant investment in technology, partnerships, and customer acquisition. But as the network expands and transaction volume increases, the economics of the platform can improve. More transactions flowing through the system can increase revenue while spreading operational costs across a larger base. This is another reason fintech platforms can become powerful long-term investments. They often exhibit strong operating leverage once scale is achieved. Affirm's long-term success will depend on its ability to continue expanding merchant partnerships, maintaining strong underwriting standards, and deepening customer relationships. If those elements remain strong, the company could play a major role in the future of digital commerce, and that future continues growing every year. Consumers are increasingly comfortable managing finances through digital platforms. E-commerce continues expanding, and flexible payment options are becoming a standard expectation rather than a niche offering. All of these trends create tailwinds for platforms like Affirm. For investors who are looking for exposure to the evolving fintech landscape, this type of business model can offer significant long-term upside, but understanding the full investment opportunity requires stepping back and comparing how both companies fit into the broader financial ecosystem. Because while Chime and Affirm operate in different segments, they are both addressing fundamental shifts in how people interact with money. And that combination is where the long-term opportunity becomes truly interesting. Now that we have looked at both companies individually, the bigger picture becomes much clearer. These two fintech businesses are attacking two different pillars of the financial system. Chime is redefining everyday banking. Affirm is redefining consumer credit at the point of sale. Together they represent two major structural changes happening across the global financial system. And understanding those changes is where the long-term investing opportunity really becomes powerful. For decades, the traditional financial model looked very simple. Banks controlled deposits. Credit card networks controlled consumer spending, and consumers had very limited alternatives. But the internet changed that structure. Technology made it possible for financial services to move out of physical branches and onto digital platforms. The companies that successfully build those platforms can capture enormous value because finance is one of the largest industries in the world. When you think about the size of the opportunity, it becomes easier to understand why investors pay so much attention to fintech companies that gain traction early. Every paycheck deposited, every purchase made, every loan issued, every payment processed. All of these activities represent economic flows that can generate revenue for financial platforms. Even a small slice of that activity can translate into billions of dollars in long-term value. That is why platforms like Chime and Affirm are attracting so much attention from investors. They are positioning themselves directly inside those financial flows. Chime focuses on where money enters the system. Paychecks, spending accounts, and everyday financial activity. Affirm focuses on how money leaves the system. Purchases, installment payments, and consumer financing. These are two sides of the same economic cycle, and both companies are building platforms that can scale as those flows grow. Now let us think about what this means for long-term investors. When people talk about retiring early through investing, the key concept is not speculation. The key concept is compounding. Compounding happens when businesses grow steadily over long periods of time while reinvesting profits into expansion. Technology-driven platforms are often excellent compounding businesses because they scale efficiently. Once the infrastructure is built, adding new users does not require the same level of additional cost. That allows revenue to grow faster than expenses as the platform expands. Chime's model benefits from this type of scaling. The platform is built digitally, meaning new users can join without the company needing to build physical branches or dramatically increase infrastructure. As the customer base grows, transaction activity increases. That activity generates revenue. And as the ecosystem expands with additional financial services, the platform can earn more revenue from each user over time. This is often referred to as increasing revenue per customer. For fintech platforms, this is one of the most powerful drivers of long-term profitability. A customer who begins with a simple checking account may eventually use savings tools, budgeting tools, credit products, and other financial services. Each additional service strengthens the relationship between the user and the platform. That deeper engagement increases lifetime value. Affirm's model also benefits from scale, but in a slightly different way. The more transactions the platform processes, the more data it collects about consumer behavior and repayment patterns. This data improves underwriting models. Better underwriting improves loan performance. Improved loan performance allows the company to expand lending opportunities while maintaining responsible credit standards. This creates a feedback loop where the platform becomes smarter as it grows. The more merchants that integrate Affirm, the more checkout opportunities appear for consumers. The more consumers use the platform, the more merchants see value in offering the payment option. This network effect strengthens the ecosystem over time. Network effects are one of the most valuable characteristics a technology platform can have. Because once a network reaches critical mass, it becomes difficult for competitors to replicate. Merchants prefer platforms with large customer bases. Customers prefer platforms that appear across many merchants. The result is a reinforcing cycle that can sustain long-term growth. Now let us return to the question that many investors care about the most. Can companies like these help investors build wealth over time? The answer depends on patience and time horizon. Fintech companies are still relatively young compared to traditional banks. They are still expanding their ecosystems and building long-term customer relationships. But that stage of development is exactly where some of the most powerful growth can occur. Early in a platform's lifecycle, customer growth can accelerate quickly. As the ecosystem expands, new revenue streams appear. And as scale improves operating efficiency, profitability can increase. This combination of user growth, ecosystem expansion, and improving margins is what long-term investors look for. Now consider what happens when someone consistently invests small amounts of money into companies that grow over long periods. A $500 investment may not seem significant at first, but when that investment compounds alongside a growing business, the results can become meaningful over time. Imagine investing in a financial platform when it still has millions of customers but the potential to reach tens of millions, or even hundreds of millions. If the platform succeeds in capturing a meaningful share of financial activity for those users, revenue growth can accelerate dramatically. This is the type of scenario long-term investors hope to identify early. Chime and Affirm are both attempting to capture financial activity in different ways. Chime captures daily financial engagement. Affirm captures purchasing decisions. Both are positioned inside massive markets, and both benefit from long-term trends that continue accelerating. Digital banking adoption, e-commerce expansion, consumer preference for transparent financial tools, mobile-first financial experiences. These are not short-term trends. They represent structural changes in how people interact with money. That is exactly the kind of environment where fintech companies can thrive. Of course, no investment is guaranteed. Technology evolves quickly, competition always exists, and financial platforms must constantly adapt to regulatory environments and economic cycles. But companies that build strong ecosystems, maintain customer trust, and continue innovating often create durable advantages over time. That is why investors watch companies like these so closely, because if they succeed in executing their long-term strategies, the upside can be substantial. Now let us bring everything together. Chime represents the future of digital banking, a platform built around simplicity, transparency, and accessibility that continues attracting millions of users who want an alternative to traditional banking systems. Affirm represents the evolution of consumer credit, a platform that integrates flexible payment options directly into commerce while building a broader financial ecosystem around responsible lending. Both companies are positioned in enormous markets. Both are benefiting from long-term shifts toward digital financial services. And both have business models that can scale as technology adoption continues expanding. For investors looking to build wealth over long periods of time, these types of companies can be worth watching carefully. Because when financial platforms gain traction early and continue expanding their ecosystems, they can become incredibly powerful businesses. And sometimes the most interesting opportunities are not the ones everyone is already talking about. Sometimes they are the companies quietly building the financial infrastructure of the future. Before we wrap up, here is something worth thinking about. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear your thoughts. Between Chime and Affirm, which business do you believe has the stronger long-term advantage in the fintech industry? Do you think digital banking platforms will dominate financial relationships in the future, or will embedded payment and lending platforms become the more powerful ecosystem? Let me know your opinion in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.